Every year, millions of people face the same decision. They have money saved, real money, and they are standing at a fork in the road. One path leads to a property with a tenant paying your mortgage. The other leads to an index fund compounding quietly in the dark. Both paths have made people wealthy. Both paths have destroyed people financially. And almost nobody has ever sat down and run the full math on both at the same time. Until now. Meet two people making the same starting decision with different outcomes. Jake and John are 32 years old. Same city, same income, $70,000 a year. And both of them just came into the same windfall, $50,000 saved. The only difference is what they do next. Jake takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. 3-bedroom house, decent neighborhood, real asset he can touch and show people. He locks in a 30-year mortgage at 7% interest. Monthly payment, $1,330. He finds a tenant willing to pay $1,800 a month. On paper, $470 a month in profit. Jake feels like a genius. John takes the same $50,000 and drops it into a total market index fund. No leverage, no tenants, no keys. He sets a $400 monthly automatic contribution and doesn't think about it again. His coworkers ask what he's investing in. He says, index funds. They nod politely and change the subject. Nobody is impressed. On day one, Jake has a house, a tenant, and a story to tell at every dinner party for the next 6 months. John has a confirmation email. For the first 3 years, Jake is living the landlord dream. Rent checks hit on the first of every month. He drives past the property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving $2,000 to $3,000 off his tax bill each year. His equity grows with every mortgage payment. Comparable homes in the neighborhood tick upward. Everything about this investment feels real, tangible, and smart.
Meanwhile, John is logging into his brokerage once a quarter, sees the number go up a little, down a little, up a little more. Year 1, his $50,000 grows to about $55,000. Year 2, $61,000. Year 3, maybe $68,000. It doesn't feel like anything is happening. There's no key in his pocket, no asset to drive past, just a number on a screen, growing in a direction nobody at the dinner party cares about. At year 3, on paper, Jake is clearly winning. More equity, a real asset, tax advantages, monthly income. Real estate is delivering exactly what everyone promised. But here is the number that does not appear on any YouTube thumbnail, any real estate podcast, any barbecue conversation with your landlord friend. The number that changes everything. Not what the rent check says, what you actually keep. The rent check is the number everyone talks about. It's on the YouTube thumbnail, it's at the real estate meetup, it's the number your landlord friend brags about at the barbecue. What nobody mentions is everything that comes out of that check before you actually keep a single dollar of it. Let's go line by line through what the $470 actually becomes. Vacancy. The average rental property sits empty about 1 month per year. That is not a disaster, but it is a full mortgage payment with zero income to cover it. Maintenance. Budget 1 to 2% of property value per year. On a $250,000 house, $2,500 to $5,000 annually. Some years it is a $200 faucet. Some years it is a $7,000 HVAC replacement in August when your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters, 10 to 12. These are guaranteed future costs in chunks of $5,000 to $15,000. They are not emergencies. They are the cost of owning the business. If you are not setting money aside every month for these, you are not running a business.
You are running on luck. And then there is the risk nobody likes to name out loud. A tenant who knows the eviction process and stops paying can cost you 3 to 6 months of lost rent, plus legal fees. That single event can erase an entire year of profit, or more.
By year 5, Jake has experienced all of it. Third tenant, roof replacement for $8,500, a plumbing emergency at $1,400, 1 month empty between tenants. He has raised rent to $1,950, which helps, but his property taxes and insurance have risen too. His actual cash-on-cash return, the money he pockets relative to the money he put in, is hovering between 3 and 5% after all real expenses. Not the 15 to 20% he quoted at the barbecue. Meanwhile, John is doing absolutely nothing. His portfolio, $50,000 plus $400 a month at roughly 10% average annual return, is sitting at approximately $140,000 by year 5. He has put in $74,000 total. The rest is compound growth. He spent 0 hours, 0 phone calls, 0 2 a.m. emergencies.
Here is the one argument real estate investors are right about, and it is a genuinely powerful one. Jake used $50,000 to control a $250,000 asset. John used $50,000 to control $50,000 in assets. That is 5-to-1 leverage. And when property values rise, leverage turns ordinary appreciation into extraordinary returns. This leverage effect is the main reason real estate has created more millionaires than the stock market in most surveys. It is also the main reason real estate has destroyed more middle-class balance sheets than almost any other investment. Leverage amplifies everything: gains, losses, risk, stress. And there is one more thing stocks cannot do. One advantage that changes the math completely for the right person in the right situation. We'll come back to it.
By year 10, something unexpected happens. Jake's property has appreciated to roughly $335,000 to $350,000. His remaining mortgage, $166,000. Equity, approximately $170,000 to $184,000. But here is what the spreadsheet also shows. Over 10 years, after every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Jake's additional out-of-pocket beyond the down payment is somewhere between $20,000 and $40,000. John's portfolio, with consistent contributions and 10% average annual returns, $165,000 to $180,000. He put in $50,000 plus $48,000 in contributions, $98,000 total invested. The rest is compound growth. And he spent exactly 0 weekends fixing anything. Same starting point, same 10 years, different everything else. At year 10, they're tied. At year 20, everything changes. This is where the story fully separates. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. His equity? Somewhere between $400,000 and $500,000. He has been collecting rent the entire time, but after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net cash profit above what he spent sits between $40,000 and $80,000. Maybe more in a hot market, maybe less in a flat one. John's portfolio, at 10% average annual return with $400 monthly contributions for 20 years, approximately $490,000 to $540,000. Total contributed, $50,000 plus $96,000 in contributions, $146,000 in. The other $350,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls. If I only showed you the downsides of real estate, I would be doing exactly what stock market influencers do when they ignore the downsides of stocks. So let's be honest about John's path too.
Volatility is real, and it is brutal. In 2008, the market dropped 37%. In March 2020, it dropped 34% in a single month. If John had $250,000 in his portfolio and watched it fall to $165,000 in a few weeks, that is not a number on a screen. That is a physical sensation. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. There is no cash flow in index funds. John's dividends on a total market fund yield about 1.5% to 2%. On $250,000, that is roughly $300 a month, not replacing anyone's income. There is no leverage. John used $50,000 to control $50,000. Jake used $50,000 to control $250,000. And there is no depreciation. Real estate investors can legally deduct the theoretical decline of their building's value from taxable income, even if the property is actually appreciating. That is a tax shelter stocks cannot replicate.
Here is the thing that the original question gets wrong. The thing every YouTube video on this topic gets wrong. The question is not which asset wins. The question is which version of yourself can execute which strategy. Real estate wins if you are in a market with strong rent-to-price ratios. If you are willing to treat it as a business, not a side hustle. If you budget for capital expenditures before they arrive. If you can handle leverage, illiquidity, and 2 a.m. emergencies without losing your nerve. Stocks win if you are honest with yourself about your ability to stay in the market through crashes. If you will not panic sell. If you can resist the urge to check the portfolio every week and override what compound interest is quietly building. The wrong investor in the right asset performs worse than the right investor in the wrong asset. Every time.
Jake worked for his wealth. John waited for his.
Neither of them was wrong. Both of them had to be right about who they were before they could be right about what they chose. The only people who got it wrong were the ones who chose based on a YouTube headline, a podcast clip, or what their uncle said at Thanksgiving, without ever sitting down and asking, which one of these can I actually execute for 20 years without quitting? Because the math only works if you stay in it. And if you are wondering what happens when you do both, when you own real estate and invest in the market at the same time, the math changes completely. The leverage stacks, the compounding accelerates, the tax advantages multiply. That is the next conversation. And it starts with understanding what most people get wrong about how to sequence those two decisions.
If you want to understand the smartest order to build both, the leverage stack, the sequencing most people get wrong, the math that quietly compounds when you do it right, that's the next video. Subscribe so it shows up when it's ready. There's nothing else like this on YouTube right now. And that's because nobody else is willing to do the math.